This episode of the Commercial Real Estate Investor Podcast is brought to you by Hamilton, a value-add investment and development firm in Nashville, Tennessee, focused on bringing passive real estate investment opportunities directly to your inbox. Visit www.investwithhamilton.com/invest to sign up for upcoming investment opportunities. Welcome back to the Commercial Real Estate Investor Podcast. Excited to be getting back with you all today. It has been fun being back on the YouTube and podcasting train. We've actually got some more educational style videos coming out starting next week, so keep an eye out for those. We've got, you're not going to believe this because it took us forever to do it, and I also haven't been posting since like September, but we've got about 70 videos that are lined up that will be dripping out every week, along with these live streams, which is really exciting for us because I have had to spend a lot of time getting those ready for you all, but I know that everybody loves having those. Quick updates. So today we sent out an investor survey to all of those of you that are on our LP investor list. If you have a chance, please take that. We're just trying to see how much capital our limited partners are looking to invest into commercial real estate this year so that we can kind of pre-plan how many raises we're going to do. We're looking for a couple of projects, probably in the $2 million to $4 million range total. Likely in East Nashville or Madison, but we're also considering Chattanooga and the Southeast if it is a triple net investment where we can add some value to it. So if you didn't get that, go to investwithhamilton.com/invest and sign up for it. We'll get that over to you and get that underway. Today is Valentine's Day, February 14th. So I figured we'd have a fun themed episode of the podcast going into love it or leave it. You know, a couple of weeks ago, we did our Urban Land Institute Emerging Trends of 2023. I wanted to talk today about the asset classes and types that I think in 2023 are going to perform well or not. Let me know which commercial real estate assets you're looking to acquire in 2023 as we go along. It'll be very interesting to hear everybody else's perspectives. Starting off, we're going to go into office space. That is actually going to be on my leave it, in my leave it section for this episode. You know, I like office space. I really do, but I think that in 2023, it's going to be changing a lot. And unless you know how to handle the shifting atmosphere around office space, it's probably not going to make a great investment. Now, this one, just like every single other asset type on this list, will have some caveats, right? I mean, if you look at office space in Nashville compared to office space in San Francisco, I love Nashville. I would leave San Francisco. If you're looking at Class A downtown Nashville or, you know, Class B in the, you know, urban core adjacent right outside of downtown Nashville, I love that. I would leave downtown. So there are going to be some of these types where I think, you know what, it really just depends on the situation, but we're going to give just an overview for that particular class. So office, I would leave it. I think co-working is exciting. Micro office space is exciting, but your traditional office space needs a lot of work, and it's going to take a lot of innovation in order to get that market right. I do think it's going to happen. I do think office is not going anywhere, but that's just my feeling for 2023. Let's get into retail. What do I think about retail? I love it. I think that retail is here to stay. It's a great investment, whether you're buying it for retail or buying it to repurpose it. Whether you're buying a single tenant net lease or a vacant shopping center, you have so many possibilities and directions that you can take with that asset class. To me, it's very flexible. They're in great locations. Typically, you've got pretty good visibility. So think about all of the other uses that would actually like a shopping center or a retail building like that. You could go for a service-based business. You could do office space. This is, of course, if you can't find a traditional retailer, but you could also do industrial. I mean, think about what a shopping center is. It's basically a very well-lit and conditioned warehouse. They typically have docks in the back, so it's very easy for them to load in and load out a lot of material. I like retail going into this market. I know that we've had e-commerce, the rise of e-commerce over the last 10 years that has really hit a lot of retailers, but more of your mom and pop local shops that actually have something unique to offer instead of these big box retailers that are, you know, getting crushed by Amazon. They are still very, they're still very much a part of the community in which they're in. So I think that retail is definitely on the top of my list. That's what we're looking to acquire more of this year. I do have a fair amount of office space, but we have more retail. The majority, probably 60-70% of our portfolio is actually retail. Actually, maybe even higher than that. Let's get into industrial. Industrial is absolutely on the love it side. Industrial in the past few years has just been doing exceptionally well. Of course, that depends on where you are in the market, right? If you look at what has been developed, though, over the last 10 years, a lot of these industrial developers are catering more towards the larger, logistics and distribution facilities, which leaves a massive, absolutely massive gap in the market for the amount of flex space that has been delivered. I was having this conversation with my brokers before I came over here. I said, go find us some land to build some flex space on. I think any amount of flex space that you can build, especially if it's 1,000 square feet of office with 2,000 square feet of warehouse, I think it will lease up before you deliver it. There is so much demand out there for that is not getting filled because there's not enough product. A lot of it's getting torn down to build something that's a higher and better use. And all the other developers are focusing on other things. Let's see. Pirate is saying Amazon is taking up to 60% of the cost to sell a product. A lot of sellers are leaving the platform. I can see retailers moving back to brick and mortar. I agree with you. I mean, a lot of these retailers, when Amazon first came out, they were the biggest platform. They were the platform, right? But now a lot of these other companies have figured out how they can actually sell direct to their consumers a lot easier without going through Amazon. And it takes a significant amount of their cost down. So, keep an eye out. I mean, many of these retailers will actually offer discounts for you shopping in store, or they'll offer discounts for you buying online directly through them because they don't have to mark it up more. Let's see. Oh no, the FBI's in here. What's your thoughts on buying a commercial property, holding it for 10 years, then using it for a 1031 exchange for a personal property while the rest is allocated into Morgan Stanley stock portfolio? That's a great question. I would have to consult with my CPA on if that's even possible to do, because I'm pretty sure that you can't 1031 exchange into a personal residence. I know that you couldn't sell your personal residence and then 1031 that into an investment. So you may want to just consult with your CPA or your attorney on that, or a qualified intermediary or QI if you have one. I get very weary when it comes to 1031 advice because there is a lot to it, and I don't like messing around with the IRS, and I don't think anybody would. But I mean, look, overall, that strategy is a very great wealth building strategy. Holding a property for 10 years, doing a 1031 exchange, moving it into something else. I think that it's a pretty great move. All right, let's move into multifamily. Multifamily is 100% still on my leave it list. Drop it. It's probably not worth investing in unless you're developing it yourself. And even that, I mean, the costs are very high. We're working with a bunch of national apartment developers, and they can't even make a lot of the numbers work on some of the projects that we were working on them with, or working with them on. It's incredibly expensive to build right now, and even though rental rates are rising, they're just not quite to where they need to be with where interest rates are too, and costs to make the numbers make sense. I think that, it's really interesting. If you look at the history of multifamily, I mean, before 2008, 2010, apartment syndications were not nearly as popular as they became in the 2010s. They became huge because, some laws and regulations changed around how you can actually syndicate these apartment complexes, which got far more people into it. And while that's a good thing because a lot of apartment complexes are now nicer, it's a bad thing for value-add investors because there's just not really that much meat that is remaining on the bone. I still think, if you can get your hands on a 5-plex, a 10-plex, these smaller units, if you're willing to deal with the property management, those can be good investments if you find the right seller. But the cap rates that I have seen on these assets, they just don't make sense. I was pitched a 5-plex here in East Nashville that I really wanted to buy just because that, it's at a great location. It will always be a good hold. But at the end of the day, they wanted a 6% cap rate when interest rates are at 6.5%. And to me, it just doesn't make any sense. And I'm not a multifamily guy. I mean, I probably could have figured it out some other way using some different type of loan, but they wanted, you know, $700,000-800,000 for it. And it just, I couldn't make those numbers work. And that's the story of a lot of multifamily. I mean, with as much capital has gone into that sector of the industry, it's compressed these cap rates down to where the returns are just almost non-existent. It makes it really, really tough to make multifamily a decent investment and get good returns on it. So I put that in the leave it pile. Cohen's saying, I'm 19 and want to get into commercial syndication ASAP. What should the next 2 to 3 years look like for me? Cohen, that's a great question. I get asked all the time, like, how can I get into commercial real estate? And man, the best way, in my opinion, is to go find somebody in your market or in a market that you want to be working in and apprentice under them, right? I think that as a society, we've moved way too far away from, you know, quote unquote apprenticeships. And it is a phenomenal way to just go learn under somebody. Look, yeah, maybe you're making $40K for your first 2 or 3 years, but the knowledge that you will gain is absolutely invaluable. You'll see how it gets put together. I mean, when I first started in the industry, gosh, it's coming up on 10 years, which is crazy to think because I'm not that old. 10 years ago, I got a job as a commercial real estate broker. I mean, it was commission only. I didn't have a salary. I didn't have anything, which, you know, I've always enjoyed. I've always been in sales. So I got right to it, got to work. But, you know, my first 2 years in brokerage, I only made $40,000 each year, right? It was, I think I looked at my tax return, like the second year was like $40,500. I was like, what in the hell am I doing with my life? But third year, it took off and I tripled my income. Made 6 figures for the first time that year, and like when I was 23. And I'm not saying that to brag. I'm just saying, like, if you get into it, you commit, and you follow the process, it will reward you. It just takes the work. You've got to put the work in. You know, I worked for a boutique development firm, so I got to sit in on all of the development meetings every week for 2-3 years before I put together my first development deal, because I learned by just watching them do it. I didn't get paid to do that. I was a broker, right? I mean, I had to also go out and lease and sell commercial space. But it was the best thing that I ever did because, you know, look at me now. I mean, now we get to do these really fun projects, and I've got a great team that helps me do it all, which is a lot of fun. So I would say just go find somebody that is doing what you want to do and find a way to just take them coffee. You know, be that person that's there to help them catch whatever they need on the back end, because that experience is absolutely invaluable. That's for sure. All right, let's see here. Brandon Armstrong, what are your thoughts on developing plazas to house general medical, like dentists, clinics, etc.? I think it's a great idea, right? You know, not only are medical tenants, which is actually on the list, we'll get to that here in a minute. Not only are medical tenants a great tenant base because they have very strong credit and they don't like to move, but they can pay relatively high rents, right? They can justify it. But biggest thing is they never move, right? And so if you create this central plaza where you have all of these, you know, dentists, a chiropractor, you've got, you know, whatever family doctors, anything, you name it, they're all there. It makes it very easy for them to say, yeah, I want to be on board with this because, you know, maybe the mom's going to be bringing her kid to the dentist and I'm going to pick up on that business as a chiropractor, and, you know, they'll come to me as a family practitioner. It makes a lot of sense. There's a lot of synergy there. That's actually why you'll see a lot of medical tenants grouped together within office buildings, medical office buildings, so that they can, you know, really play off of each other's clients, right? Because they're not necessarily competitive. Let's see. Pirate saying, and rent control is spreading across the U.S. They won't ever rent control industrial, office, or retail. Yeah, I mean, you know, commercial real estate is, you don't have to deal with nearly any of the issues that you do in multifamily. I mean, multifamily, gosh, I couldn't even imagine having to, like, that's one of the biggest things, honestly, that has kept me out of multifamily. Like, could I raise capital for it and make these deals work? Yes, because a lot of people are willing to take a 6% or 8% return on their cash just to get into apartments. That's not exciting to me, but there are a lot of people that will invest in that. The biggest thing for me is, like, I don't want to deal with people's homes, right? It's you know, maybe it's a moral thing or, you know, whatever, but I don't ever want to have to evict somebody. You know, I get that they're in the wrong, right? But I don't feel bad evicting a business. Like, this is a business. You are supposed to be doing this to make money, to pay me money, to be in these spaces. And, I'm trusting that you're going to go do that. That's why I'm giving you my space. To me, I know it's the same principle on the residential side, but it's somebody's home. I don't really want to deal with that. FBI, thoughts on industrial real estate? I feel like that's the one market I've never seen go bad. Commercial had its moments, as did residential, but has there ever been a downfall in industrial? Actually, there was a downfall in industrial when we had the, when what was it? The Atlantic trade bill passed, and we started exporting a lot of our industrial out to China, Mexico, some of these other countries. That actually caused a pretty huge crash in the industrial market. That's why you'll still see to this day mills, warehouses, stuff like that, that used to be these massive manufacturing facilities that are still vacant. But I will say, yes, they're far more steady than most others. I would say be very careful getting into industrial real estate in terms of the price point. What I have started to see over the last 10 years is a significant rise in rents, and there's only so much that industrial tenants can pay. And now I know that that's a factor of how expensive it is in the demand, but traditionally, historically, industrial real estate is not that expensive. And now we're seeing rates competitive with retail. Could there be a point where industrial rates actually surpass retail rates? I think that that's possible, and it's a really interesting thing to think about. What if industrial becomes more expensive than retail real estate because everybody's focusing more on delivery and logistics? It's certainly a possibility. It's very interesting to think about and see where that could head. I love industrial. Typically it's not the highest and best use for a property. So a lot of your competitive properties where your tenants would potentially be looking to lease are getting torn down. They're just not in the market. They're not in the market anymore. Cohen is asking, can I be that person for you? That's great, man. I love the verve to get in here on the podcast and ask that. But man, DM me on Instagram. It's right there on that side at Commercial in Nashville, and let's talk. I'm always open to talking to hustlers. All right, let's get into our final main category, which is hospitality. That is your hotels, motels, Airbnb. This may surprise a lot of you, depending on which side of the pandemic you've been on, but I love it. I think that I think there's a massive opportunity in the hotel industry, especially if you're buying in the right areas, right? Again, getting back to our caveats, I don't think Chicago is a great area to be buying a hotel right now. I don't think that California or New York is probably the best place to be buying a hotel. However, if you're buying in the Sun Belt, right, that's all the way from Arizona, New Mexico to Georgia and Florida, and anywhere in between, I think that those are great. You've got a lot of people that are wanting to get out and go on vacations, and those are typically where they're going to go, those areas, those warmer climates. So, I think that they're very interesting. Denver's pretty cool, right? I mean, I think of when it comes to hospitality, what are the cool destinations that are going to be kind of, that are going to draw people without me having to worry about it too much? So, fortunately, Nashville is one of those. That's why we're building a hotel right now. That's why we're under contract on a second hotel. I just think it's very interesting. And, a lot of people back when the pandemic hit, you saw hotels get crushed. That is the one thing that you really have to watch out for when it comes to investing in commercial real estate or hospitality specifically is, if you get a down economy or another pandemic happens, you could lose 100% of your tenants. I mean, I talked to hotel guys that were like, yeah, we went from, almost full occupancy to zero, like literally zero people coming to the hotel, and we had to figure out what to do to keep the lights on. And that's crazy to me, right? And so, when we go into those, we're very conservative. We make sure that we have a healthy amount of cash set aside just in case. You don't want to overdo your distributions to your investors just because you're feeling good, because you never know what can happen, right? So something to keep in mind. Brandon's asking, what's the general loan look like for new construction? Are they charging 10% plus interest rates at 30 years, or is it typically a 2-year loan? Are there ways to get creative with lenders? if you're talking to people that are charging 10% plus, I would walk away, walk very fast. Typically what I'm seeing right now is somewhere in the like 6 to 8% range. I know that's not very far off from 10%, but we just got some quotes in the 5.8 to 6.5% range, right? They're typically on a 20-year amortization. If it is a fully amortizing note, typically what you will see on a construction loan is that it is interest only for a certain period of time. We typically try to get those loans in the interest only time frame between like 18 months and 24 months. Sometimes banks will do like 12 to 15. You just got to really work with them to try and push that, because you don't want to be paying full principal and interest while you're not even delivered yet, right? So they typically won't amortize them. You'll just be paying interest only. 10% interest is not the worst if you're paying interest only. It's just a much higher interest rate and something that you're going to have to, throw into your underwriting to see if it's going to work. But no, 30 years, a 30-year amortization is very rare in commercial real estate. You can typically achieve that on, super Class A properties with like a life insurance debt policy. But usually what you'll see is 20 years, and sometimes you'll see 25, right? I mean, we've got a couple of deals where we have a 25-year amortization that really makes the deals cash flow well. But, again, one thing to keep in mind, when you go to sell it, a 25-year amortization compared to a 20-year amortization, you're not going to have as much equity built up in it. You're going to be paying more in interest. So it just depends. Do you need more cash flow right now, or do you want to, actually build more equity into the property faster? Let's see, FBI saying, I know a gentleman who owns a Red Lion and Hilton jointed together in Bellevue, Washington. He's now rezoning all of it to condominiums and apartment high-rises due to the aftermath of COVID. That's one of the major opportunities right now at hotels. A lot of them are still hurting post-pandemic, and they're trying to sell. We have talked to almost every hotel in Nashville. I think that we've got quite a few. I'd have to get with Tyler Brock on our team, because that's kind of what he specializes in. But man, he's digging up hotel opportunities left and right for people that want to convert them to apartments or tear them down and do something else. I mean, they're out there. It just depends on what you're looking to do for them. I mean, I wouldn't buy a roadside motel and keep the flag, keep the brand that's like a La Quinta Inn or whatever, and try and operate that and make money. That doesn't make sense to me. I'm sure there is some money in that, but you can't pay today's prices and really make those deals make sense anymore. Devontae's asking, how do you feel about Raleigh, North Carolina for office? Raleigh's an interesting market. I think it's very strong for office, because you've got a lot of that New York financial industry that's kind of down there as well. I went out there. Raleigh was not very exciting of a market to me, and that may be a controversial thing to say, but I always heard, Raleigh is so similar to Nashville. You've got to get out and see it. And I got out there, and they've got their business district is literally the business district. There's a couple of things downtown. You've got the stadium down there, the football stadium, which is pretty cool. But outside of that, I just kind of found their downtown a little bit boring. We had to get out into the adjacent neighborhoods to go to the cool bars and restaurants, which is fine, right? Like, I mean, I do that in Nashville. I don't go downtown. I go to the, surrounding areas. But I just thought it was interesting because, like, at 8 o'clock at night, the downtown was dead. It was weird. But it was thriving during the day. So, yeah, I mean, I think office space in Raleigh would do really well. All right, let's move into some subgroups. These are the popular subgroups. I'm not going to go into every single potential subgroup that we could ever talk about, but these seem to be the most popular right now. First up, I had to get a drink of water, would be medical office. We touched on this, absolutely in the love it pile. I think medical office tenants are incredibly strong tenants to have. Banks love them, which means that they're going to give you better interest rates, better terms typically. They'll sign 10-plus year deals. They don't like to move. Medical office is more expensive to build on the front end, but typically these tenants are willing to pay for that. So it makes a lot of sense for you financially and for the tenants as well, just, again, depending on where you are. Medical office in the middle of nowhere, probably not that great, right? But medical office in a tertiary, secondary, or primary market, I think you do really well. I like medical office a lot. Let's see here. We've got self-storage. Again, like I said, subgroup. Self-storage could be lumped in with industrial. I love self-storage. So it's going to go into the leave it pile, but I've got a big caveat with that. And here it is. Self-storage cap rates in the last 10 years have compressed so much that it concerns me. I just don't see how those cap rates are going to end up paying off with the amount of interest there is from new developers on building self-storage. So, I mean, look, when back in 2012, 2013, you could buy a self-storage facility at like a 12 or 13, or even, I even saw some that were like 18 caps. Right now they're down to 4, 5, and 6 cap rates. That's crazy to me. Absolutely crazy, because all it takes is somebody else to come online, build something new, and now you've got a major amount of competition. And let's be real, there's not a whole big barrier of entry to get into self-storage. It's one of the cheapest assets to build. So as long as you've got the land, you can go do it. I mean, it's like $35 a square foot compared to, I think, a new office building is probably in the $175 to $225 a foot range, and probably higher. So I would be careful with self-storage, but I still love it. I think that a lot of people are going to continue to move into apartment complexes that are becoming smaller and smaller. So there's going to be a solid opportunity for people that need to place their stuff somewhere until they eventually think that they're going to buy a house. I mean, if you look at default rates on self-storage and COVID, they were the lowest out of every asset class, despite, the pandemic, because people looked at it and they said, well, it's only $50 a month. I'm not gonna go pick up all my stuff for $50 a month. We'll just leave it there. So I thought that was pretty interesting. Let's see. Speaking of Bellevue, it's also on the up and coming. It's right next to Medina. Bill Gates, Bezos live there, and is becoming the new business hub. Have you been to Bellevue, Washington? I actually haven't. I have been to Seattle, but I haven't spent a lot of time in Bellevue or in Washington in general. I need to get out there. I've actually been talking to my buddies about getting out there, going to North California, Oregon, and Washington. Be a lot of fun to just see those cities and see kind of how they're way down. I mean, I know Portland's weird. I want to see how weird it is, right? What are your thoughts on commercial in Houston, Texas? Ooh, Brandon, it's tough. I mean, look, I think Houston is a great city overall in terms of commercial real estate. I am not personally a fan because, man, Houston, my dad lived there for 8 years when I was growing up, and so I would visit him every summer. And that humidity is brutal. And I'm coming from Nashville. Like, Nashville's pretty humid. Houston is somehow worse. The mosquitoes there are insane. So I think that I have a little bit of bias from growing up and going out there and just not liking Houston at all. But Houston's big. And one thing that's really interesting to me about Houston is that you don't really have zoning. You could go build a skyscraper within a neighborhood if you really wanted to. Now, a lot of that doesn't make any sense at all, right? And so the market has kind of helped determine that. But, look, as long as you're buying in the right areas of Houston, he was kind of in the Rice University area. It was a nice area. I really liked it over there. As long as you're buying in the right areas, I think you can do something cool. Pirates saying medical is also recession-proof. It is, right? I mean, it's like owning a liquor store. In good times, people are drinking. In bad times, people are drinking. I mean, your health is something that's just always going to need attention, whether it's a good economy or a bad economy. It doesn't really matter. So, yeah, I agree with that wholeheartedly. Let's see. Ina, how do we know a market is saturated on self-storage? Great question. I wouldn't call. Well, I guess you could call. Someone like CBRE or one of the bigger commercial real estate firms and see if they'll do a market report for you. You can also find these market reports in places. There are some self-storage management companies that will actually do these market reports for you in hopes that they get your business on the management side. That's the best way to do it. We've got a property out in Chattanooga, and that's kind of what we did. We reached out to a self-storage consultant to see what their thoughts were on self-storage in the area because we looked around and we're like, yeah, it really seems like it is not saturated at all. Like, there is a huge need and probably demand for self-storage in this area. But I don't like making decisions just based off of my gut feeling 100% of the time, unless it's something that I've been doing for a while, and self-storage is a relatively new asset class for us to be investing in. So I went to these groups. They'll send you a report, and it basically says, yes, it's saturated, or no, there's an opportunity here. Here's all the units. Here's the units demand. And so that's kind of how they'll do it. So it's like, hey, there's 1,000 units in the area, but there's demand for 1,200 units, right? Okay, well, I can go build 200 more units to fit that market. Kind of how that works. Okay, moving on. This is another subgroup that's popular, build to rent. These are neighborhoods. You guys have probably heard me talk about it before. Neighborhoods, communities, cul-de-sacs, whatever, where developers are coming in, developing these, building all of the homes, and then never selling them. They are renting them out. And I got to say, leave it. Maybe there's some money there. Cap rates have gotten pushed up. So values have come down on these assets, but there are still big buyers out there for them. Overall, I mean, again, maybe this is an ethical or a moral thing for me. I just don't believe that the home ownership opportunity should be stripped like that. I think that it actually creates a lot of problems for the market when people cannot buy single-family homes. These are homes that are getting built. They're taking up land that could house people owning their own properties, and they never hit the market. So can there be money made in them? Of course. There probably is a good amount of money, but I don't want to be the guy that's stepping on other people's American dream just to make a dollar. Everybody's got their own little quirks, right? That's one of mine. Cohen's asking if I can walk y'all through my most creative deal. Cohen, happy to do it. Let me do this last one, and then we'll dive into that because I think that'd be interesting. Would love to hear your questions on that. Final one is, and this is not really a subgroup, but it is a type of renovation or development, and that is adaptive reuse. I think adaptive reuse, especially with where interest rates and construction costs are, which makes it very cost prohibitive to go do anything new, adaptive reuse is going to be incredibly popular in 2023 and is certainly in the love it pile. I think any opportunity that we can take an existing building and renovate it and bring it back on market. I mean, one, not only is that more green, but two, it kind of helps maintain character in neighborhoods, especially if it's an older building that is actually contributing to the character of the neighborhood. But it's a lot faster. It's so much, it can be cheaper. Sometimes it's more expensive depending on what you're doing, but it's a lot faster than, having to go develop something completely new, put all these plans together, go ground up. I mean, sometimes with these buildings, you can literally just throw a new HVAC unit on the roof, replace the windows, replace the lighting, and you're done, right? And you can do that in a few months. So I love adaptive reuse. I think that should definitely be in your love it pile for 2023. So Cohen, getting back to your question, walking you through my most creative deal. I've done a couple of videos on this one before. I still think it probably is our most creative deal. And maybe you could clarify what you mean by creative, because there's several different ways to get creative. Of course, there's the financing, acquisition, capital raise side of things. But I'm thinking you mean like actually doing something creative on a project. And if I'm wrong, let me know. But we took a 6-bay car wash in East Nashville and converted it into 5 micro restaurants and a bar. And that was an idea that I had during the pandemic. My brokerage was getting a lot of calls from restaurants that they wanted, micro space. They wanted a kitchen with no seating, basically. And I kept having to tell them, hey, that doesn't exist in Nashville. That's just not really a thing around here. It is impossible to find that. I'm sorry. I'll keep an eye out in case something comes up. And we'd been working on this project. It was a 6-bay car wash for the previous owner. At the time, my property management company managed Airbnbs, which we don't do anymore. I could tell you all about that another time, but that's a nightmare. And they were planning on doing 6 Airbnbs in the stalls. And it was really interesting because if the building got torn down, Metro Nashville was going to condemn 20 feet of right-of-way. Well, this is a 0.1 acre lot, very tiny. I mean, if you look up the Wash in East Nashville, it is a postage stamp of a lot. We have like 3 parking spots for six concepts. So if they condemn 20 feet of right-of-way, there'd be nothing useful there at all. And so we had to work within the existing walls. And the previous owner had looked at office and retail, and it wasn't really exciting to them. Then they were looking at Airbnb, and they were like, well, I guess that's really the only thing we can do here, so let's do that. And so, but then the pandemic hit, right? And so they put that project on pause. And I was driving by one day. I'd just gotten off the phone with another restaurant group telling them, hey, sorry, these micro spaces don't exist. And I looked at the car wash. I was like, man, wouldn't that be weird if all those bays were little restaurants? And at the time, ghost kitchens were like the big thing, right? Everybody was talking about ghost kitchens because that's how restaurants were kind of solving their issues. I was like, that'd be really interesting if we had like retail facing ghost kitchens. That'd be pretty cool. So called my architect. He said, yeah, we can do that. And we're off to the races. I mean, we had that fully leased within 2 weeks of announcing it. And it's been a very successful project ever since. So the Wash was by far my most creative project to date, I think. Brandon's asking, how can we help you? Is there a way we can send you deals to potentially partner on? Yeah, love it, man. Look, we're always looking for really good deals. If you find triple net investments, mostly in the Southeast and the Sun Belt, we're always willing to look at those if they're, 8%, 10% cap rates or higher, which I know can be tough to find, or anything that you find in the Nashville area or Chattanooga. Those are very interesting markets to us. So we're always looking to look at deals out there. But yeah, there you have it for this week's Commercial Real Estate Investor Podcast. Hope you guys liked this episode of Love It or Leave It. Let me know in the comments what you are going to love this year and what you're going to leave, because that's really going to determine your success in commercial real estate in 2023. I'll see y'all next week. Thank you for listening to the Commercial Real Estate Investor Podcast, brought to you by Hamilton, your resource for passive real estate investment opportunities. Visit www.investwithhamilton.com to start building your passive real estate portfolio today.